Next, we will look at how to do the accounts for partnership. And firstly, how is the recording when a partnership is formed? Okay, so we look at an illustration where two people, okay, two partners, they come in hand together to form a partnership. And how do they record the bringing of the capital of each of the partners? Okay, in this illustration it says here that A. Rolf and T. Shia combine their proprietorships to start partnerships named US Software. So two of them have their own businesses before they form the partnership, and Rolf and Shia have the following assets prior to the formation of the partnerships. Okay, so before they form their partnership, they have their own assets from their previous business with the book value. So book value is what is the value as in their own accounting records. Okay, so A. Rolf has cash $8,000, has equipment, the book value or the historical cost of 5,000 of equipment, but that equipment carries an accumulated depreciation of $2,000 and bringing a total book value of 11,000, whereas Shia has cash $9,000. It has accounts receivable $4,000 and allowance for doubtful accounts $700. Okay, these are the book values as in their accounts, but when they want to join together, they reevaluate the value, the market value of their assets and liabilities, or well, their assets. Of course, cash is cash. Okay, so this is the same value, but then equipment, when they reevaluate the value of the equipment, they come to 4,000. That's the market value of the equipment. The accounts receivable is 4,000, but when they evaluate the doubtful accounts, what is doubtful accounts? Is the amount of the accounts receivable that they are providing an allowance, which they expect could be bad debts, or the accounts receivable that they are expecting that the customers will not be able to pay. So they re-evaluated that and they come up that as $1,000. Okay, so in total, the fair value of Rolf's business, original business, is 12,000, which is 8,000 plus 4,000, and Shia's original business has a fair value of 9,000 plus 4 but minus 1, which equals to 12,000. So each of them are bringing capital to the value of 12,000, although their original book value is different, but we take the fair value instead of the book value. So how do we record it? How should we record the transaction for Rolf bringing his old business into the partnership? So we need to debit the assets that he brings in, which is cash $8,000 and equipment at fair value, which is 4,000, and together 12,000 is credited into Rolf's capital account, which is 12,000. So this is the owner's equity account for Rolf. So in partnerships, the capital account must be attributed to the specific partner. So here we said A. Rolf, capital. This is the capital account for A. Rolf. And then for the investment of T. Shia, again we debit cash by 9,000 and we debit accounts receivable by 4,000, but then we debit allowance for doubtful accounts of 1,000. So we are left with capital for T. Shia capital of $12,000. So this is how we record the initial formation of the partnership when each partner brings in their assets into the partnership.